Let's talk about what just happened in the silver market. We saw a flash crash, a sudden, violent plunge of nearly 10% in just a matter of minutes. Around 11 a.m. Eastern Time, the price just fell off a cliff. So the question is, what was behind this? We're going to deconstruct the entire move. So that's the immediate question on every trader's mind, isn't it? What could possibly trigger such a dramatic sell-off? Was this driven by a real fundamental shift in the market, a technical breakdown, or was it something else entirely going on under the surface? That's what we're here to figure out. To put this into perspective, we're talking about a $9 drop. That's a decline of over 10% in a single session. And look, this wasn't some slow, gradual drift downwards. This was a vertical drop, an absolute cliff. Now, the official narrative, the first thing everyone pointed to as the catalyst, was the latest U.S. jobs report. But as we're about to see, when you dig into the actual data, this explanation doesn't just look weak. It creates a significant paradox. The market's logic, at first glance, seems pretty straightforward. The headline screamed strong jobs, which makes the market think the Fed is less likely to cut interest rates. Higher rates for longer are generally negative for non-yielding assets like silver, so the market sells off. Simple, right? Well, not exactly. And this is where the official story starts to unravel. The headline number that sparked the sell-off was a reported gain of 130,000 jobs in January. But what got far less attention was the massive downward revision to the previous month's data. The Bureau of Labor quietly revised December's figures down by a huge 48,000 jobs. So let's just do the simple math here. When you factor in that revision, the net gain over the last 2 months was a paltry 82,000 jobs. For an economy the size of the U.S., that's a weak number, not a strong one. This completely contradicts the rationale for the sell-off. So, if the catalyst doesn't hold up to scrutiny, we have to look elsewhere. We need to examine the market's internal plummet. Okay, so if the why is questionable, we have to investigate the how. How could such a weak signal trigger such a massive price move? The answer lies in the underlying structure of the market at that very moment. Here is our first major clue. You see, fundamentally driven market moves, real panic selling, are almost always accompanied by a huge surge in trading volume. This event was the exact opposite. This massive price drop happened on very low volume, which is a big red flag. It suggests the move wasn't driven by broad institutional selling. And you can see it right here. Look at the trading volumes for the 3 days leading up to this event. Monday, Tuesday, and Wednesday saw the lowest number of futures contracts traded since before the Christmas holiday period. The market was incredibly thin. And in a thin market, a market with low liquidity, even a relatively small sell order can have a huge outsized impact on the price. It's like trying to stop a heavy object on a sheet of ice. There's just no friction, no opposing force to slow it down. The price drop was dramatically amplified by the simple lack of participation. But thin liquidity was only part of the equation. It explains how the price could fall so fast, but not necessarily why the pressure was so intense. There was another, even larger structural factor hanging over the entire market. And that factor is the expiring March futures contract. As of the day before the drop, you still had over 65,000 open contracts, representing a massive 327 million ounces of silver. All of those contracts needed to be closed or rolled over before the expiration date. This creates an enormous incentive for anyone holding a large short position to smash the price lower. 如果你觉得我们的视频不错，请点赞、转发和订阅关注我们，这样就会不会错过精彩后续了。So when you put it all together, a weak catalyst, extremely thin liquidity, and immense pressure from the contract expiration, what should we be monitoring going forward? Well, it boils down to 3 key risks. The timing here is absolutely critical. The Shanghai physical market, which is a huge driver of price, is about to close for an entire week for the Lunar New Year. That's tomorrow. Then you have a Friday, which is already a historically volatile day, and that's followed by a U.S. market holiday on Monday. This creates a long, dangerous window where Western paper markets can operate without the grounding influence of a major Eastern physical market. This leads us directly to our 3 core risks. Number 1, the market is highly vulnerable to manipulation, especially with Shanghai closed over a long holiday weekend. Number 2, this low-volume instability could easily persist, meaning more sharp, volatile price swings are very possible. And number 3, that contract expiration pressure on the huge March contract is only going to intensify as we get closer to the final delivery date. So we're left with this one critical question. In a market this thin, with this much structural pressure from an expiring contract, was the jobs report the real story? Or was it simply the convenient excuse, the perfect narrative cover for a much larger, calculated move designed to exploit the market's fragile state? That's the question you should be keeping in mind.